I am normally a hide behind the podium kind of girl, and Ryan says I can't sit down. So I'm going to stand up for a little while until my knees give out. And as Jim mentioned, my mother was born and raised in Rensselaer. She always pronounced it Rensselaer, not Rensselaer. And so I grew up hearing about Rensselaer, and my father was born and raised in Albany. However, I was raised on military bases. I've never lived in New York one day in my life, but I visited a lot. And I have cousins and everything in New York, and I'm very fond of New York, but I've actually never ever lived here, even though I'm from New York. In any event, I was very excited to be invited by this group to speak here because I feel very connected to New York and have a lot of fond memories in this state. So to clarify a little bit what we're doing today, even though it's a workshop, we had a couple questions earlier. You won't be actually preparing returns on your computer. I think if we were doing that, you would have heard that by now. But what we're going to be doing is we're going to go through some general trust rules and compliance matters. Then we're going to walk through line by line what lands on a trust tax return. We're going to talk about the trust accounting income and the distributable net income. And then we're going to go through an entire example of a simple trust, an entire example of a complex trust. And you're going to find all these completed forms and the related worksheets in your handout. So that's something you can refer back to. So you might take a few notes today, but you may not need to take many notes because everything we're talking about today is definitely reproduced in your handout. So let's go ahead and jump on into what we're talking about. So specifically for a trust tax return, and it may be trust or estate. So if someone passes away without a living trust or without a trust already established, perhaps from an AB trust, from a marital assets being split into two trusts or something, then the assets they leave behind would be considered their estate. And if those assets they leave behind earn income after their death before the assets are distributed to the beneficiaries, there may be an obligation to file a Form 1041. It just wouldn't be for a trust because they didn't have a trust, potentially. It would be considered their estate return. But unlike a 706 estate return, a 706 is a tax on the value of assets when someone passes away. And I was talking with one of the attendees before we got started today. Very few of the trusts that we're actually going to prepare for our clients are going to have an affiliated 706 because most of our clients don't generally have $13 or $14 million of assets when they pass away. I usually only see maybe one every couple of years. I just had one audited, which thank heavens went okay. And then I'm involved in another one right now where the first spouse has died in Los Angeles and the marital assets are about $45,000. So they're definitely going to have a 706 and all those good things. But generally, when you're doing a 1041, there will oftentimes not be a 706 or an actual estate tax return affiliated with it. And so as a 706 taxes the value of the estate if it's over the exclusion amount, a trust tax return, the 1041, that taxes the income on the assets that are earned after the deceased passes away. That's basically what's getting taxed, is the income of those assets after subtracting eligible expenses. Okay, so here's our filing requirement for a 1041. If the gross income is $600 or more, whether or not it's taxable, okay? So if the gross income, let's say from dividends, is $650 and your prep fees and the fiduciary fees are $900, there's not going to be any tax due, but because gross income was $600 or more, there is a filing requirement for that 1041. And then we have another example here. If the gross income is $599 of state muni interest, then, for example, no 1041 would be required. Then the second filing requirement is if there's even $1 or more of taxable income, okay? So if the gross income is $500,000 sale of stock and it has a $1 capital gain, then we've got a 1041 required. And then we have an example where it not be. The third filing requirement, it looks like my bullet points are a little bit messed up here, but our third filing requirement, if there's any beneficiary that is a U.S. non-resident, then we would have a 1041 filing requirement. Okay, so here's our example of our 1041. This, we have marked the box here on the upper left-hand side of the simple trust. We're going to talk about the difference between a simple and a complex trust. Do not wake up in the middle of the night 6 months after you filed one of these and went, oh my goodness, I think I checked the wrong box. We do the best we can to get these right, and hopefully you'll learn a little bit more today so you have a better chance of getting the right box checked, but I wouldn't lose a lot of sleep over that if you accidentally check the wrong box one day. But generally, and we'll talk about what constitutes what they consider a simple trust versus a complex trust, but this is our form. And notice the beginning date is February 12th, so that would be the date of death of the deceased, and generally ends in a calendar year. There's an election to do a fiscal year, which we'll talk about towards the end of the presentation. Okay, so specifically for what's called a simple trust, generally the trust document should state that all income is required to be distributed currently. And we do mean income. We're not talking about cash or other assets. You know, somebody got mom's car or something like that. We're specifically talking about income earned on the assets of the trust. There may be a rental property in the trust. There may be interest, dividends, those types of things, earnings on the assets that were in the deceased person's estate at the time they passed away. And we're going to also talk in a few minutes about how we might allocate that income between the deceased 1040 and the 1041, because sometimes that work falls on us to do that allocation. And then specifically for a simple trust, there can't be anything in the trust document that indicates any charitable bequests, okay? So we need to be careful that we're familiar with that specific filing requirement to be able to check the box for a simple trust. Okay, now, if it has a charitable bequest or there are other funds distributed other than just the income of the trust, then it would just be considered a complex trust and we would check the other box. And again, we're going to go through an example of a complex trust in our presentation today. And then if the complex trust makes, if the trust makes any distributions other than current income. Okay, so a simple trust, which is what we're going to walk through first, is entitled to a deduction for the income distribution deduction, and it's equal to the amount of income that's required to be distributed, whether or not it's distributed. So if we've got a trust document that says that these one or more beneficiaries get all of the income of the trust, the interest, the dividends, perhaps rental income, and it's all to be paid out every year to the beneficiaries, that is a simple trust. You will file it as a simple trust, whether or not that income actually got distributed. And so that, it makes life a little bit easier for us. And again, this is something we were chatting about before the presentation. Generally, you're going to be getting a brokerage statement or some savings, 1099 ints, 1099 divs for wherever the funds are deposited or are being held of the deceased person's assets at the time they passed away. You may also be getting a little profit and loss or a worksheet based on whoever might be managing perhaps rental property that the deceased owned before they passed away. You're going to use those documents to determine what is the income that was earned by this trust after the deceased passed away. And then, and by the way, so for compliance purposes, a simple trust can distribute less funds than are required, okay? And specifically, they can also distribute funds later. So let's say somebody passes away a little bit later in the year, none of the beneficiaries were particularly hurting for cash, so they were just kind of, maybe two siblings, and they were just kind of doing their best to wrangle all the documents and the assets, and they hadn't really taken any distributions. So maybe in the second year of that trust, maybe they got last year's income and this year's income. Maybe they don't distribute any income for 5 years. It doesn't matter. If the trust document says that the beneficiaries are eligible to get all income of the trust for the year, then that's how the trust is prepared, is that the beneficiaries will then be taxed on their pro rata share of the income that could have been distributed, whether or not it was distributed. Now, if the trust ever distributes more money than was permitted, then that would create that would cause us to check the box for a complex trust, and we'll have a little more math to do and work to do in our worksheets, in our tax software, to be able to determine what is actually going to belong on the K-1s for the beneficiaries and what distribution deduction the trust is entitled to. And we'll walk through those lines on the form also. Now, a complex trust may not be required to distribute all of the accounting income currently. There may be various reasons why they're choosing to hold back some income. They may also have specific dollar amounts that they may say that, let's say there's a couple of grandkids in college, for example. The deceased grandma might say, I want any of my grandkids that are in college to get X amount of money per month, just for, let's say, to accommodate their living expenses or something like that. And they are entitled to receive that money regardless of how much income the portfolio accounts are earning, for example. So that would make it a complex trust. And remember, regardless of how much funds might be distributed to a beneficiary, either the beneficiaries of the trust are still only going to pay tax on the actual earnings, interest, dividends, potentially capital gains, less any deductible expenses of the trust. And we're going to talk about what are actual deductible expenses of the trust. So regardless of how much cash someone may get, if we've got, for example, a beneficiary or an heir that's getting a set dollar amount per month for their living expenses or something else, they're still only going to pay tax on their pro rata share of the distributable income. And then also remember, for a complex trust, there may also be distributions to charities, okay? And there may also be amounts of corpus to the beneficiaries. Okay, now, so specifically for a complex trust, the income distribution deduction is limited to the current year distributable net income. And we're going to walk through worksheets that show us what's the difference between our fiduciary accounting income and our distributable net income. We're just trying to set up a few ground rules first to kind of get our head around that, okay? And again, the distributable net income is generally the portfolio income, might be rental income, earned by the trust assets regardless of how much was actually paid to the beneficiary. So here we have an example of a complex trust. Again, it may say, pay the beneficiary $48,000 per year in 12 monthly installments of $4,000 due on the first of each month, okay? That's paid regardless of the income of the trust, okay? And another example might be, let's say the trust document is written as a simple trust. All the income gets paid out to my two grown children every month or every year. And then it might have some verbiage like, at the discretion of the trustee or the fiduciary, if any of my two beneficiaries communicate with the fiduciary that they need funds for some reason, maybe house repairs, maybe a vehicle, whatever, and if the trustee is permitted to make a distribution to them of other income, then it might be a simple trust for a couple of years, and then, oh, somebody got $40,000 this year to do some home repairs. So for this year, perhaps it's a complex trust because they distributed more cash than was the actual income of the assets this year. So again, we might see this on, a trust that we're preparing for a client might switch from simple to complex from one year to the next based on what occurred that year. Okay, we have a little chart, and this is also in your handout. I'm not going to read the minutia of this chart, but basically, we talk in the first row here about the 1041 checkbox. And we talk about when we're going to check the box for a simple trust, if all the income is required to be distributed, whether or not it's actually distributed, okay? And no other funds were distributed, and there were no charitable contributions, okay? And we're going to check the complex trust box if all the income is not required to be distributed, or funds in excess of the income is required to be distributed, or if there's charitable contributions. So this will kind of inform us as the 1041 preparer which box we're going to check. And then we have some information between a simple trust and a complex trust is the distributable net income and the trust accounting income for that specific trust, and then the income distribution deduction. And again, we have this on a handy little chart, but we're actually going to work through these terms and these calculations and some worksheets in our presentation. Okay, so first thing we want to do is we're going to kind of walk down the 1041 about what is landing on each line of the 1041, and especially in the first year of death, how we may decide which goes on the final 1040 and which goes on the 1041 for the year. So for example, line 1 of the 1041 is interest, okay? And so we can use generally any reasonable method to allocate. What you're going to find as a 1041 preparer is, let's say the deceased passes away April 5th. Well, they may leave money in that account that's being reported under a Social Security number for sometimes months, sometimes years. I have one client that, unfortunately, she recently passed away, but for the last 20 years, she brings me in a 1099 int in her mom's Social Security number, and her mom's been dead for 20 some odd years. And it's never a lot of money. It's always like $170, $120. And every year we put it on her 1040 because they've never closed the account. They've never moved the account. She was the only heir, a zillion years ago. And so the one distinction we need to make as the 1041 practitioner is what tax ID number is this account in that I have been given to show me the interest or the dividends or the capital gains or whatever it may be. And so what we want to look at in the year of death is what interest was earned in the account that's in the Social Security number of the taxpayer up until date of death. And again, as I say in the second bullet point, it's often an account that's held open all year or substantial months after the death, or again, it could be for many years, okay? And then, so you can allocate the interest by number of days, number of months. I use an example. If a taxpayer died on April 5th and the account was kept open all year, you could just do 1/4 of the interest to the deceased and 3/4 to the trust. I mean, it's not a huge problem there. And I would caution you occasionally, like I said, occasionally you're going to end up with one or more clients that have got substantial assets. So if 1/4 of the interest or the dividends, the bigger that number gets, the more you want to be a little more precise, right? Because especially in the case where some beneficiaries are entitled to that income, you don't want a situation where your little rounding error is $9,000 or something like that, that maybe the beneficiaries might have been entitled to. So, but again, when it's a little bit of money, the smaller the numbers, the more I just, I'm going to allocate and just make it easier. And then also keep in mind this specifically for something like interest income. Sometimes what will happen is mom will die in March and they sell the house in October. So you've got this 1099 int. But a gigantic amount of that interest might have really been earned in the last, say, 2.5 months of the year. And so after death. So it might not be 1/4 and then 3/4 because potentially in this one account where they parked all the cash from mom's house, that may have earned a substantial amount of interest compared to the interest earned before they sold the house. So we just want to keep in mind any what I call large taxable events that may have occurred. So so there's other things you do. Again, as these dollar amounts get larger, you can also can I have a copy of the March 31 bank statement for that savings account? And just what was the year-to-date interest on that account? So there's different reports or records you're going to ask whoever you're dealing with to provide so that you can have some level of comfort as to how you're allocating income in an account that was open past death that was in the Social Security number. And then once assets have been moved into an account that's in the EIN of the trust, you're not allocating anymore. Once it's in an account that's in the EIN of the trust, that's always going to be reported on the 1041. Now, the second line of the 1041 is our dividends, line 2. And again, dividends are a tiny bit easier to track if it seems to be kind of a material amount, because if you've got a substantial amount of publicly held stock, for example, a lot of times dividends are announced. They're quarterly or semi-annually or something like that. And again, the more substantial these numbers are, get a copy of the brokerage statement for the month of death. And now you've got the 1099 for the end of the year, and you'll be able to see what were year-to-date dividends, for example, the month that the taxpayer passed away. So those are oftentimes easier allocations for us to find and to be able to have a note in the file how we made that allocation. Okay, and then, so the easiest thing a little bit is actually the stock sales, because the stock sales are literally, they have the date of the sale on it. So the sale was either made up to and including the date of death, or was made after the date of death. So specifically for stock trades, that's the easiest one for us to go, I know exactly which one goes on the 1041 versus the 1040. I've got a case right now where we've got some siblings squabbling, and one of the ladies who used to do a lot of day trading with Dad, who passed away, one of the daughters, grown daughters, she probably did a little too much internet searching, but in any event, she believed that any assets held in their brokerage account at the time he died could be traded multiple times, and it's all tax-free. So I'm not kidding. And they ended up with, he had, at the time he passed away, this guy had a fair amount of assets. At the time he passed away, they had almost $1 million, the loan on stocks, I forget what you call that. Thank you, margin loan. And she was afraid the mom would be upset. So she frantically did all this trading after he died, and she earned plenty of money to then pay off this margin loan, because she and Dad, who was ill for years, she would be up there, you know, in the den with Dad doing all this trading that Mom didn't know anything about. So Mom ends up with like this gigantic amount of capital gains she had to pay. And the daughter kept telling her, Jane's doing your tax return wrong. And I finally called her up and said, well, you've got to stop saying that. I'm not doing anything wrong. What is the problem? And she goes, no, those are all stocks we inherited from my dad. Therefore, it's all tax-free. And I'm like, no. Only the first time you traded after he died, that's the step up. And she honestly had no idea. And so it created a huge problem in this family, but because she truly didn't understand that. And I finally convinced the mom, look, I know you don't want to pay the $100,000 of tax on all this gain, but, because the gain was about $500,000. And I said, but you would have owed $1 million margin loan because you got all the real estate. So whether you like it or not, this is what you owe. These are real numbers, and you can yell at your daughter when I'm off the phone, kind of thing. So yeah, that was painful. And to try to figure out why this woman kept telling her family that there's no tax on all these trades. There's no tax on all these trades, when they were multiple trades long after he passed away. So in any event, okay. So again, back to dividends, we want to get the brokerage statements as close to date of death as we can. Find out what the year-to-date dividends were, and that's going to help us with our allocation, again, in year of death. Now, we do have some specific rules for qualified dividends when we're managing, that we're reporting this on the 1041. And the part here in our second bullet point, anything in italics I've usually taken from IRS guidance or the instructions. So specifically for line 2B of our 1041 qualified dividends, the amount of qualified dividends allocatable to the beneficiaries in the case of a simple trust or a complex trust which distributed dividends needs to be allocated based in the same proportion as total dividends, okay? So they're giving us guidance here that the qualified dividends have to follow the actual dividends that were reported to the beneficiaries and or paid tax by the trust, okay? And so then here we have on line 2B, we have our amount of qualified dividends allocatable to the trust or estate. So this is just a little sample worksheet. A lot of times I just do this on what I call a control sheet, where I just list all the various little brokerage accounts or bank accounts, and I just put 1040 and 1041, and the far right column, the total, that'll be what's on my 1099 div or my 1099 int. And then I'll just go down and say, this is going to be on the 1040 and this is going to be on the 1041 based on how I've done those various allocations for this specific deceased taxpayer in the year of death. Okay, now, and by the way, this is only done in the calendar year of death. As I mentioned a little bit earlier, anything reported in a Social Security number after December 31 of the year of death will never, ever, ever, ever be reported on a deceased 1040. A lot of people really don't understand that. And sometimes these are big, could be big numbers, depending. But you will never file a 1040 for a taxpayer after December 31 of the year they passed away. You might be reporting their activity and their earnings, but you're going to be reporting it on a 1041 if that's the case. It would not be on ever a 1040. Okay, so now line 3 of our 1041 could be if there was a sole proprietorship, perhaps owned by the deceased when they passed away. The trust or estate might have some Schedule C income potentially. And then line 4 is going to be capital gain or loss. And we're going to talk in our 2 samples today, our examples, about whether the capital gains are going to be taxed by the trust or we can pass the capital gain out to the beneficiaries. We'll see 2 different examples of that. And again, the capital gain or loss, as I mentioned, is usually easiest to allocate because it's based on the date the sale occurred. Then again, in our 1041, we have our line 5, which is our rents, royalties, or pass-through incomes from K1s. Partnerships could be S Corp, or even the deceased may be getting, for example, a K1 from the B Trust when they pass away, right? So we'll have to see what K1s might be reported on the trust this year. And we'll talk about this a little bit later also, but when we do have income that's specifically coming from a pass-through, a K1, we're only going to count any distributions from that K1 this year. So let's say that there's a K1 from a rental partnership and there's $20,000 of rental income, but the partnership didn't make any distributions that year at all. Then we won't include that $20,000, even though it's taxable. We won't include that $20,000 in the financial accounting income because they didn't get any cash this year. And we'll look at some examples of that too in a few minutes. So again, as the practitioner, if we're given a K1 that we need to report on the trust, we have to pay attention to what were the distributions from this pass-through activity before we know how we're going to report that for our accounting income. Okay, and again, pass-through profit or loss earned after date of death reported in the Social Security number should be allocated between the final 1040 and the 1041. So maybe we would do something, and it all depends on how well do we know perhaps other practitioners that are, where's this S Corp tax return coming from, something like that, for example. S Corp K1 coming from. For example, maybe we're doing everything for the family and we could very easily go run a little QuickBooks report, right? That cut the P&L off that we use for that, for example, that we use to prepare that K1 for the full year. Other times is, again, if it's not substantial amounts of money, maybe we're just going to go ahead and say, they died April 5th. I'm going to take 1/4 of this S Corp K1 potentially, and then maybe 1/4 of the distributions. Unless I feel these are material amounts or I have some reason to believe that there's substantial large taxable event or something that occurred that year that I need to make sure gets allocated correctly. Emily, did you need me? Oh, okay. And then again, most reasonable methods for us to allocate this are permitted. And again, I'm talking about allocating the rents, royalties, partnerships, and those kind of good things. Now, we don't have time to do a deep dive on this today. However, I do reference a case here, a tax court case, and there are some cases where the trust activity may actually qualify to deduct rental losses as a real estate professional. So sometimes that has to do with the activity of the beneficiaries. Sometimes it has to do with the activity of the fiduciary or the trustee. So you might consider that if there are large rental large rental losses, and there are multiple properties perhaps in a trust or an estate return, that would they benefit from that and would they qualify? So you might double check on that. Oh, the tax note here is what I mentioned before. Income from a pass-through K-1 to the trust may not be included in D&I unless income was distributed to the trust. And the amount that's included in the D&I is limited to the distributions from that K-1 for that tax year. Okay, and then we have a few other miscellaneous lines on the 1041. Line 6 would be if there's any farm income or loss. Perhaps the deceased owned a farm and was filing Schedule F on their personal return. We might also have line 7 of the 1041 would be ordinary gains or losses. There might have been some business assets held by the trust or estate that were sold, and they're going to be reported on Form 4797. And then we also have line 8 of Form 1041, which would be other items. It could be taxable portion of pension, IRA distributions, could even be compensation paid after the taxpayer's death. So those will go on line 8 of the Form 1041. Okay, now here's where things get a tiny bit interesting for preparing the 1041. We're only permitted on the 1041 to enter expenses that are actually tax deductible. And this changed a great deal with Tax Cuts and Jobs Act, and our new tax law in July, OBA, kind of doubled down on this, where expenses that are basically what we know of as the miscellaneous itemized deductions subject to the 2% floor, most of those things are no longer deductible. And so they're not a tax deductible item for a Form 1041, even though they are bona fide expenses incurred by the trust or the estate. So an example would be, for example, let's say the deceased had a condo and it's vacant for a few months and we're paying the condo fees. Maybe we're paying the homeowner's insurance or something like that. We used to be able to deduct those subject to the 2% floor based on the fact they were from maintaining an asset in the trust. Those are no longer deductible on Form 1041. And we're going to actually look at how we've got some manual entries. No matter how much we rely on our 1041 software, we've got some manual entries that we need to make as the tax practitioner, because there's some things that are actually were bona fide expenses of the trust or estate that our software knows nothing about until we put it in there, even though it's not tax deductible. So we're going to have to think about those things. And a little bit later in the presentation, we'll also talk about tax planning now for trusts might be a little different. Might we want to capitalize some things and be able to deduct it if that condo later sells versus things we generally might have been trying to deduct perhaps annually if we held the house for a few years. So we'll talk about that a little bit later, and also we'll have a discussion on what expenses are actually deductible on the 1041. Okay, so now line 10, so we've done our income items, okay? So now we're on our expense items that are deductible for the trust, and this is going to be lines 10 through, I believe, 15. So the first line is interest, okay? So this would be interest paid after the date of death, generally on the deceased's primary residence or another home they own, subject to the same limitations we would see on Schedule A. If there is interest expense on actual investment property, let's say raw land or something held for an investment, or there's interest expense, for example, on rental property or a commercial building, that is going to go on the applicable forms where we would report the rental activity. But this is specifically line 10, would be deductible interest for generally the primary or secondary home of the deceased. Now, occasionally when one of the taxpayers pass away, a friend or family member is permitted to live in the home. So it might end up being the primary or secondary home of a beneficiary, and that home may be managed by the fiduciary. So that would occasionally be deductible mortgage interest for the 1041 based on the same limitations we would have on Schedule A. So for example, it must be acquisition, the portion of the interest that represents acquisition debt to buy, build, or improve that home. And it's also subject to the same limitations we would see on Schedule A. Generally, if mom's home is just vacant for 6 months before you sell it, that would be investment interest, and that would be deductible on the 4952. And then that deductible investment interest, based on the 4952 limitations, would flow to line 10 of the 1041. Okay, now, both the home mortgage interest and the investment interest must qualify as acquisition debt, as we already mentioned. Also, occasionally you'll have a client, a deceased taxpayer that has had a reverse mortgage. Generally, reverse mortgage, what will happen is the home gets sold upon the death, and then you get this 1098 with this enormous amount of interest on it. That is generally considered equity interest and not considered acquisition debt at all. So you need to resist the urge that you've got this gigantic 1098 that you get to deduct, because generally it is not deductible if it's interest from a home that was subject to a reverse mortgage, and then it all gets paid when the home gets sold. Okay, so for our investment interest, as I mentioned, we're going to file our 4952, and we're going to include that amount on our line 10. And then the personal interest, the regular rules apply. So what if mom bought a brand new car in February and then she passed away in March? I think we're going to find that trust may be eligible to, for example, get our car loan interest if it was a brand new car assembled in the United States, et cetera, et cetera. So we need to look for changes like that that might show up on the 1041. But personal interest, for example, mom's credit card, if she had equity debt on her home or something like that, that would just be personal interest that will never land anywhere on the 1041. It's an expense, a bona fide expense of the trust or estate, but it's not tax deductible on the 1041. Now we want to talk about line 11, which is taxes. So specifically, up to December 31, 24, the SALT limitation for a trust or an estate was $10,000. That is now increased to $40,000 for deductible taxes. Oftentimes, this may be property tax on one or more properties held by the deceased, but it wouldn't be, that's not where you'd put the property tax, for example, for a rental, or let's say a commercial building or something. That would just be specifically for generally their residence or other property that may be held for investment. And then occasionally, every once in a while, you'll find a trust or estate that was eligible for a PTET election. Occasionally, it would also go there. Every couple of years, I have a client who inherits something from either they've inherited property in India, or they've inherited property in Italy or some other country. And remember, foreign real estate taxes are not tax deductible. Real estate tax is not tax deductible. If they have paid foreign income tax, they're not subject to the $40,000 SALT limitation that would be applicable on Schedule A, but they still may benefit from getting a foreign tax credit rather than taking a tax deductible expense for foreign income tax. So that's something you're going to want to evaluate a little bit. And then there may be bona fide expenses from the trust that are just flat out not deductible. It could be federal tax paid. Could be, for example, federal tax paid perhaps on a tax return of the deceased. Could be federal trust tax paid, trust income tax paid, or other estate and gift taxes. So there definitely could be bona fide tax expenses in the trust that are still not going to be deductible on Form 1041, line 11. Okay, fiduciary fees. Of a lot of the wrangling we've got to do to figure out what costs are going to be deductible or not, fiduciary fees are fairly easy. And the reason I mention that, and we'll talk about expenses a little bit later, is what came out of the rules with Tax Cuts and Jobs Act and some other IRS guidance is if there is an expense that you would have if there was no trust, generally it's not deductible. Now, there are exceptions to that. No one can, you haven't been able to deduct your personal tax preparation fees ever since Tax Cuts and Jobs Act, but not only can you deduct the trust preparation fees, but you can also deduct the 1040 preparation fees for the deceased, even if they were a non-filer, okay? Because what occasionally happens is the deceased has been ill or has been ill for a few years, and they kind of haven't really caught up on their income taxes. So you may end up with a situation where someone passes away and you're doing the 1041 and you need to do potentially 3 years of 1040s, let's say, for the deceased. In which case, that is an exception to the 2% rule, is the deceased's tax preparation fees are deductible by the trust. And then certainly the tax preparation fees for the 1041 are certainly deductible. Also, any fiduciary expenses, probate fees, any costs you would have that you have solely because there is a trust. The example that I mentioned a little earlier would be, for example, the condo fees for holding on to mom's house for a period of time. Those wouldn't be deductible because if mom were still living, her condominium fees would not be deductible to her. And so that's the distinction we make with the line 12 fees. Now, line 13 is also going to flow from the 1041 Schedule A, line 7, that's page 2. And we've got some information about specifically charitable trusts. So generally, charitable contributions permitted by the trust document and paid from the income estate, not principal, are deductible. So, and we've got there's more information about this on the 1041 instructions, but it generally, if it generally mentions a percentage, like 10% of my assets I want to go to a certain hospital or something like that, then we'd be able to take a deduction for up to 10% of the income for that year that the contribution is made. We also need to make an allocation if there was some tax-free income. Then let's say that the tax-free income was 10% of the income of the trust or estate, then we'd only be able to take a deduction for 90% of the charitable contribution that's permitted, because 10% of it is deemed to have been paid from tax-free income. So that's some of the nuance we have if we're deducting a charitable donation on a complex return. If the trust, or excuse me, if the will or the trust says donate $50,000 to the hospital as a lump sum, then that is not a charitable donation that is permitted. So be aware of that. I think I have a little more information on the next slide. Also, we have an election available that we can deduct a charitable contribution that is paid in the subsequent year. We can deduct it from this year. That's another special election that we have. Oh, here we go. I knew I had a little more information on charitable bequests. Okay. So these are charitable bequests, actually, or contributions that are permitted by the trust. Again, in some closely held family situations, somebody might say, gee, mom and dad love the zoo. Let's donate $10,000 to the zoo. Well, that's nice, but the trust didn't tell you to do that type thing. So we need to be careful that some of the things that we may be trying to take as a deduction on the 1041 were actually permitted by the trust. And did the trust indicate it's a lump sum, or did the trust say 10% or something like that? Because that tells us, as the practitioner, whether or not we have a charitable deduction we can take. Okay, so charitable donations that are mandated as a percentage of the trust or estate are generally deductible from taxable trust income, and it's calculated as the applicable percentage of the net income. So whatever the percentage of the assets were, we'll take that percentage of the income for that year, and that would be the permitted deduction, okay? And I think we have some additional information, like I mentioned, about if it's paid from tax-free income. Okay, so we would also allocate any permitted charitable deduction between taxable income and net non-taxable income. Could be muni bills or something like that. And then the deduction would be reduced by the percentage that is deemed to have been paid with non-taxable income. And then, as we mentioned, charitable bequests or contributions which are permitted by the trust but mandated as a specific lump sum are not deductible to the trust. And remember, if we do have a bona fide charitable donation for the year, that would automatically then, we would check the complex trust box. Now, attorney fees, accounting fees, and tax preparation fees. These are also fairly simple to manage. We'll talk about some nuance on attorney fees a little bit later. One of the things you're going to find that isn't in this list is going to be the brokerage fees. We'll talk about those a little bit later. But generally, any attorney's fees that the fiduciary or the trustee is consulting with the attorney may be doing things like changing the title to property to the trust. When assets are distributed, they may be changing the title of property to the whoever's inheriting those assets. So those are attorney's fees that we may be incurring. There may absolutely be accounting fees for who is managing all the assets and potentially preparing reports either for the court or for the beneficiaries, or reports that are needed to prepare the tax return. And as I also mentioned, tax preparation fees. So generally, any of these fees related to the fact that there's a trust or estate or related to the deceased taxpayer are going to be deductible. But there are some expenses, as we've already mentioned a little bit, might not be deductible, okay? And again, tax prep fees, even though they wouldn't be while the taxpayer is living, are deductible by the 1041. Now, we might have other expenses. Yes, sir.
Those administrative fees would have to be prorated also if you had tax.
So the question is, if we have administrative fees we can deduct, and we have some tax-free income in the trust, we would allocate that. And we're going to see a little example of that when we do our simple trust, but that's absolutely correct. Yes. Yes, sir.
Speaking about allocation, I just want to go back to that reverse mortgage. If a person used a portion of that to substantially improve their home, new roof, then an allocation could be made on the reverse mortgage?
I agree with that. So the question is, if somebody took out the reverse mortgage and they used part of those funds to substantially improve the home, could a portion of that interest be deductible? Here's the other problem I have with the guidance that says it's personal. What if you had a mortgage when you got a reverse mortgage, and what if part of those funds paid off the original true acquisition debt? So I agree, there may be cases where part of the interest paid when the home is ultimately sold with a reverse mortgage may be allocated to bona fide either acquisition debt or, again, might have paid off an original loan that was still attached to the house. So I think it bears looking at and maybe inquiring of the beneficiaries. I think that's a very good point. Okay, so here's an example of a non-deductible fee, and this gets a little sketchy. But for example, let's say we're going to keep mom's home for her elderly sister who can live there during their lifetime, okay? And then the home will be sold, and this may be decades potentially later, who knows, right? To mom's remainder beneficiaries, let's say her grown children. And so let's say we need an appraisal on that home because we're just trying to make sure we have the correct insurance coverage. We haven't bothered to appraise the home for any other reason, which is kind of a weird example, but let's just go with us there. If the appraisal is just for the purposes of making sure we have the right amount of insurance on the home to protect the asset, and this is an IRS example, technically that appraisal fee is not deductible to the trust. But if we get an appraisal on that home for the purposes of establishing the values on date of death that we need, or for allocating assets to the remainder beneficiaries, then that appraisal fee would be deductible by the 1041. And I don't love that example, but it's an IRS example because I think when someone passes away, you should probably always get real estate appraised. But in any event, that's their example. But that gives you an idea of they kind of do the same thing with brokerage fees. We might as well go ahead and talk about that real quick. Regular plain vanilla brokerage fees that get charged like 1% of assets or whatever by our regular 1040 clients, those have not been deductible for quite some time. However, let's say the fiduciary is tasked with allocating some of these portfolio assets, or they're tasked with like doing certain, like maybe doing more like income growth versus, you know, safety or muni allocations or whatever. So the fiduciary may hire a brokerage firm and say, can you prepare these calculations for us for the purposes of managing the trust assets? That fee, even though it's paid to Merrill Lynch or paid to Fidelity, whoever, that would be a bona fide tax deductible expense of the trust, when the regular management fees for the portfolio would not be. And the IRS guidance even goes so far as to say if you have bundled fees from a brokerage account, you may have to allocate any fees that were incurred based on specific trust activity you needed to perform versus just managing the assets in the trust. So again, these are some of the things we're going to have to wrangle a little. But if at the end of the year we just get somebody's, you know, 1099 int div B for the brokerage account and there's fees there, some states permit those fees still to be deducted by a trust, but federal doesn't. But we might again inquire of the fiduciary or the trustee. You didn't hire the brokerage firm to do any special allocations or anything for you, because maybe some of those fees that we're seeing on the year-end 1099 would be deductible by the trust. Okay, so now let's get into the income distribution deduction. So generally speaking, and this is kind of a funky concept, and a lot of times, like most tax issues, a lot of times we get these after the fact, so we don't have much time to intervene. But what we're going to see here is based on what is spent out of the trust, the assets held by the trust, we may be actually trapping income at the higher trust rates. And depending on how everybody is getting along in terms of the beneficiaries and how many beneficiaries they are, sometimes, for example, mom's condominium fees, if they're going to hold on to that house, it would actually be cheaper for the family as a whole to, you're already distributing money, to just say, why don't you and your sister pay the condo fees and pay the homeowner's insurance and you know, pay some of these other bills, because if I pay it out of the trust funds, it's not a tax deduction, and we're trapping taxable portfolio income at the highest trust rates. But again, that assumes that we're going to be able to get in front of these types of expenses being paid. And number two, it also assumes that everybody's getting along and everybody, you know, a lot of times one sister doesn't like how the other sister's handling something, and we want to stay out of the middle of that. So, but if we could really do anything we wanted to do and actually help a group of heirs manage and solve for lower taxes, we would try to have some of the non-deductible expenses paid by the heirs personally and not paid out of the trust income. But we'll see how that will have an impact on them in a little bit. So again, generally it's better to pay taxes on the income at the beneficiaries level if that's manageable with that family group, okay? And it's specifically due to the lower individual tax brackets, right? Now, after Tax Cuts and Jobs Act, which drastically limited some of these deductions, and a lot of the income distribution deduction at the trust level is limited to DNI. DNI is a function of the amount of income left to distribute. So we're, again, sometimes trapping taxable income at the trust level, when if we could have gotten in front of it a little bit and everybody cooperated a little bit more, we could have saved some trust taxes. Okay, so here, and this is also more kind of nuanced with the income distribution deduction. Trusts and estates in high tax states or with a high amount of non-deductible fees such as broker advisory fees are, after Tax Cuts and Jobs Act, these trusts actually owed income that, and it caught some practitioners kind of by surprise. Most of us have been dealing with this for a while now, and we're used to, because we were used to deducting the brokerage fees and the condo fees and all those things. And then but after Tax Cuts and Jobs Act, we were actually ending up with more income than we had ever seen before trapped at the trust level, which caused all kinds of problems. A balance due if we put the trust on extension. It may have thrown a trust into a requirement to pay estimated taxes. And then here come the letters to the fiduciary, and it's all your fault, and yucky things were happening. So we want to, if you're not familiar with trusts, you haven't done many trusts, we want to be careful if we're putting a trust on extension to try to evaluate, to the extent that we've got access to the information, should we be making a substantial payment on the extension? Sometimes we're not sure, right? And then, by the way, OBA did not change AMT for trusts. Okay, now, Schedule B, so this is our page 2 of our Form 1041, has the trust accounting income. It might also be considered financial or fiduciary accounting income. Now, that doesn't print on the Schedule B, but most of our tax software has a little worksheet that will have our tax accounting income worksheets kind of on our Schedule B when we're in our program, even though it doesn't print on page 2 of the 1041, okay? And the DNI, the distributable net income, is calculated on lines 1 through 7 of that section of page 2 of the Schedule B. And then the income distribution deduction is calculated on line 15 of Schedule B. And we're going to walk through some examples of this. And that determines the amount we're allowed to deduct from all the taxable income we're reporting on page 1. And sometimes that's our goal, to get that taxable income of the trust down as low as we can. So our Schedule B, line 8, is our accounting income calculated by the tax program for known items. So for example, we're going to see in our sample here that I had property tax for the residents of $15,000 during the trust portion. Well, because I put $15,000 of property tax in, the tax software knew $10,000 was deductible for 24 up to the SALT limit, and the tax software knew, and we have this other $5,000 non-deductible expense, but it knew to reduce it from accounting income because they knew the expense had been incurred because I put that the property tax was $15,000. We're going to see in a couple of slides here where I need to go in and tell my software other items my software doesn't know about that have been spent out of trust income. So, other items not entered for 1041, such as non-deductible brokerage fees, will need to be manually entered to arrive at trust accounting income. And we've got some examples for that. So, the financial, or what they call fiduciary accounting income, generally refers to income available to be paid to the trust income beneficiaries for that year. It includes interest, dividends, perhaps rental income, and any other ordinary income. And then principal assets of the trust and capital gains are generally not considered in the financial accounting income. And those are generally reserved and held with the assets to be ultimately distributed to the remainder beneficiaries if they're different potentially from the income beneficiaries. And then generally when the trust accounting income is calculated, capital gains are not included in trust accounting income, and capital losses are also ignored. Now, in our complex trust today, we're going to talk about when we might go ahead and tax capital gains to the beneficiaries. We'll have that in our sample. Okay, so the trust accounting income is trust income less expenses, whether or not the expenses are tax deductible. So that's what causes the pain at the trapping taxable income at the trust level. So this is accounting income, okay? So now we're going to talk about our distributable net income, okay? So D&I calculations determine the income distribution deduction the trust may deduct on the tax return. So for simple trusts, we have a little typo here, I got an extra D. The IDD is limited to the lesser of trust accounting income, which is required to be distributed based on the verbiage in the trust and the DNI. And a simple trust is going to deduct that distributable net income calculation whether or not it was distributed. Remember, a simple trust has to be required to pay it out to the beneficiaries, but it doesn't actually have to be paid. Kind of a crazy concept. And then for complex trusts, the income distribution deduction is limited to the lesser amounts of what actually got distributed that year or the distributable net income. And we'll walk through some examples of that. Now, on our Schedule B, income distribution deduction, the DNI, which is the distributable net income, is the maximum amount of trust taxable income that is taxed to the beneficiaries for a simple trust. And in the case of a complex trust, it's a result of what was actually distributed to the beneficiary. And we've got some sites there for you. We also have a little information in your handout on the different tiers of distributions, but we're not going to be able to spend a lot of time on that today because we want to get to our little examples. Now, distributions in excess of DNI is treated as principal and is not taxable to the beneficiary. So as I mentioned, if the trust says, pay my granddaughter $4,000 a month while she's in college, only a portion of that $48,000 she receives this year is maybe her pro rata share of the interest or dividends or potentially even rental income of that trust, and she may get substantially more cash in the $48,000 than she's actually getting taxed on her K-1. That's the distinction we're trying to make. And then capital gains generally will only pass through the beneficiary if the trust document includes them as accounting income or requires them to be distributed, in which case they may be deductible to the trust as deductible income. So this has been kind of a long-going kind of debate among practitioners for years. And what a lot of attorneys are doing these days is they're kind of saying at the trustee or the fiduciary's discretion, you may distribute capital gains. And what they're trying to do is, again, trust tax rates are very high, even for capital gains. And so, because the level at which you get to the top capital gains rate, that income level is much smaller than for a 1040. So they're now trying to add some verbiage into the trust documents that you didn't see very much at all, let's say 30 years ago, where it's saying if need be or if it makes sense, then the fiduciary or the trustee can pass out some capital gain income to the beneficiaries during the year, in which case, again, that saves the group income tax. Okay, now, here is our basic simple trust. And again, we have all this information in your handout, so don't worry too much about taking great notes because you'll be able to refer back to this. So here in our basic simple trust that we want to walk through, if we do this right, we'll have about 45 minutes for each one of these samples we'll walk through, and then we'll do some compliance matters towards the end. Now, so in this case, we've got taxable interest income of $895. We have tax-free interest income, $900, ordinary dividends, and then the qualified dividend portion of that. We have gross rents of $27,000. So that's actually the cash received from the tenant. Then we have applicable rental expenses of $2,600. And then we have rental depreciation of $15,455. So that was rental depreciation that was calculated with the step up on date of death. And the reason that depreciation is separately stated on the K-1s is that the trustee is responsible for passing income out to the beneficiaries in most cases. Depreciation is not a deduction that, in other words, the trust didn't spend any money to incur a depreciation expense. That's why depreciation gets separately separately allocated to beneficiaries, because depreciation is not considered an expense of the trust. And then we have our tax preparation fees. And as mentioned a little bit earlier, I think it was Frank, that we're going to notice that our $500 in tax preparation fees are going to be reduced by the percentage of our interest, our tax-free interest income. We're going to allocate that deduction. Then, as I mentioned, we've got $15,000 of property tax, And because this was a 24 tax return, only 10,000 of that property tax is going to be a tax deduction for the trust. Then we have our home condominium fees before we turn mom's house into a rental. And then we've got some brokerage fees. So let's see how, and so this is all the information we've gathered from the trustee on what occurred this year. And so the first thing, we're going to enter these things in our trust software, and almost all of our trust software is going to have our little worksheets where we're actually entering this income, these documents we've been provided, 1099 divs, maybe the little rental P&L from the management company, something like that. So we've got our total income, column A. Then we have any tax exempt income, that's our $900. And then we have our taxable income in the far right column. And these percentages down at the bottom are going to be come into play a little bit too. Now, so again, this was our income we've entered. So now I'm only entering in the tax software, for this purpose, expenses of the trust that I know are deductible. So I entered my whole $15,000 of property tax, but they're limiting it to $10,000. And I entered the entire $500,000 of tax preparation fees. But notice what's happening in column D. Only $485 is going to be deductible by the trust, because $15 of that, and you'll see that at the very bottom line there, $15 of that $500 tax preparation fee is deemed to have been paid by the tax-free income, tax-free interest, excuse me. Okay, so here is our 1041, page 1 for a simple trust. And if we were to have dual screens here, here's our interest income, $895 on line 1. Line 2A are my ordinary dividends. And notice on 2B, we're allocating our qualified dividends to the beneficiaries and to the estate or the trust. Line 4 is capital gains, because capital gains for this simple trust are going to be reported on the trust return. And then the line 5 for the rents. This is our $27,000 of actual rent collected from the tenants, less the $2,600 of rental expenses, but there's no depreciation there, okay? So now we've got our $30,697, and that's considered income of the trust. And then we're going to walk and then look at line 11. That's our deductible portion of our $15,000 of property tax. And line 14 is our deductible portion of the $500 tax preparation fees after we allocated from the tax-free interest. So that's how I've put the items in the income worksheet and the expense worksheet, and this is how they're landing on the front of the 1041. So then here's our Schedule B, and we're going to look at a worksheet of where our $20,212 came from in a minute. Then there's, so what we're trying to calculate now is what may we deduct on the front of the 1041 so we don't have to pay those high, awful trust tax rates, okay? So we've got our $20,212 as our adjusted total income, and we're going to look at a little worksheet on that. Then we've got our adjusted tax-exempt interest, which is our $900 less our $15 allocated tax prep fee. We're backing out the capital gains on the front page because that's deemed to be retained by the trust itself. That capital gain won't be passed out to the beneficiaries. So now let's go look at our line 8 accounting income and for a simple trust, line 8 and line 10 will generally not be calculated. Notice our line 8 is blank if it's a complex trust, enter the accounting income, and line 10 is there other amounts paid or credited. With a simple trust, we would normally never see those lines filled out, okay? And then income required to be distributed annually from a simple trust is the trust accounting income, not taxable income, and not the taxable income as determined when we're preparing the income tax return. Now, again, we've got our 1041, page 1, line 17, is our $20,000 212. Remember, $20,000 212 was our first line on our Schedule B, which is page 2, but that was also on line 17 of our page 1, and we're going to look at the difference. We're going to look at where our 20,000 came from in just a minute. Then we have our tax-free interest less our $15 that we chatted about. And then line 12, we have our tax-free interest. Schedule B line 12 is our tax-free interest, which is our $885 times our ratio of the 11,987 and the 17,097. Let's find out where those numbers are coming from. Because, okay, here we go. Now, adjusted total income is $20,212. So remember, we have that on line 1 of our 1041, on page 1 of our 1041, and we also have that, and that's page 1, line 17, and then we also have that at the beginning of our Schedule B. So that's our interest income. Now, look at what the $1,795 is. That is our taxable and our non-taxable interest income. We have our dividends for the moment, ignoring qualified. We have our capital gains. We have our rent less our rent expense, ignoring depreciation. Then we have our deductible property tax on our home. And we have our $500 of tax prep. And we've got the entire $500 stated here because we have the tax-free interest up there under interest also. So now we're going to subtract out our tax-free interest, subtract the $900, and we're going to add back that $15 of tax prep fee that was allocated to tax-free interest. That is how we're getting our $20,212 that we see on page 1 and page 2 of our 1041. Now, let's look at how that, remember a couple minutes ago I said, look at the ratio of the 11,987 to the 17,097. So if we look at line 7 here on this worksheet, this is our distributable net income. And we get down to line 9, that's our accounting income. So we start, again, line 1 with our 20,212. And we're going to then add our tax-free income, less the $15 of prep fee. We're going to subtract out our capital gains. And that comes with our distributable net income, because the capital gains are deemed to be retained by the trust, of $17,097. But now I've got a problem. I had that extra $5,000 of property tax paid. So I've got to subtract the $5,000 of non-deductible property tax. The condo fees were actually deemed to be an expense of the capital assets, the principal assets of the trust. So we're not deducted, even though the condo fees were paid, they were deemed to have been paid by corpus, paid by principal, not paid by current year income. So even though I know condo fees were paid, I'm not considering the payment of the condo fees in the accounting income. Now that is a judgment call. You may feel differently. I actually debated this with half a dozen practitioners before we landed where we landed, and there are different points of view on that. And then I've got my brokerage fees of $720. So in theory, half of the brokerage fees are going to be attributable to the corpus, the trust assets that remain in the brokerage account, and half those fees are going to be allocated to the income generated this year by the brokerage account, the interest or dividends, and then also half the tax prep fees are going to be allocated half to corpus. So we've already deducted $500 for tax preparation fees because they were paid that year, but we're saying really half of those tax preparation fees are for preparing the trust tax return, which also applies to the corpus, the principal of the trust. So now I'm going from distributable net income all the way down to what we call our accounting income. And so this supports our numbers that's landing on our 1041. And what you're going to find is these amounts, the $5,000 was going to probably automatically calculated by our software, depending on your software. But I've had to go in and make an adjustment for half the brokerage fees because they're reported nowhere on the 1041. And I've got to also add back half the tax prep fees. Question?
Why is the allocation 50%?
Because it always is. I mean, honestly, that's just a general rule, that half the prep fees. I mean, could someone make a case for the fact that there's $50 million in the brokerage account and it only threw off a little bit of income this year, so but generally it's always considered half the burden of the principal, the corpus of the trust, and half deemed to be that the income for the year is responsible for it. I've never seen it allocated any way other than 50-50. Have you seen that before? No, I haven't seen it allocated other than 50-50. Question? That's correct. Right, and we're gonna look at the Schedule E and how that's calculated. So the question was, she's noticing that there's no depreciation here, okay? Remember, the rental income and the rental expenses are up there in our 20,000, but the depreciation is not anywhere, because the depreciation is not considered a cost or expense or in any way attributable to the trust. It is for wear and tear on an asset, and it is not a transaction that occurs through any of the trust accounting or anything like that. So let's go ahead and take a look at how those are then. Oh, and so then just to give you a complete example, I answer our little compliance questions here. And the top question is the one we'd probably be the most likely involved in, is where we're going to identify some tax-free income potentially of the trust. And when we put it in our little income worksheet that we had when we first started preparing our 1041, they'll push that to that line for us in most of our software. Okay, and just for fun, I went ahead and reproduced the 24 trust rates here. And as you can see, they get up to, a trust gets up to 37% at $15,201. So you could see how it really benefits the family if you can get everybody to cooperate and be a little proactive to try to handle some expenses differently than just paying everything through the trust, because that's convenient and I want Mary to do it, for example. But a lot of times it's fraught with peril to try to get involved in some of these family discussions. You just report what they actually did and maybe try to give them some advice for the following year. But anyway, we have this in your little handout, a comparison of these rates. Okay, so here's our Schedule D, and this just shows our $4,000 of capital gains. And we already showed how, because this is simple trust, the capital gains are going to be attributable to the actual trust income and not flow through to the beneficiaries. Now here's our Schedule E. And notice on this Schedule E that's being filed with the trust, we still don't have any depreciation reported on this. This is just the $27,000 rents collected from the tenants and the out-of-pocket expenses. These were expenses that were deemed to have been paid from those rents collected. If there was, let's say, the expenses exceeded the rents, potentially those expenses might have been paid out of other income of the trust this year, or potentially even corpus in some years. Now, the rental income is only $24,400 because 100% of the depreciation is allocated to the beneficiary, who in this example is entitled to 100% of the income, the rental income, excuse me. And then here, depreciable property was $600,000. And again, this is based on, a value on date of death. And then it's allocated between the K1 Statement A and the Trust Schedule A, which we're going to talk about in a minute. And then also we would have only been depreciating the building portion. Actually, do I have that wrong? Yeah, look, I've got the whole $600,000 there. Probably not a good idea. Let's see if we have that allocated somewhere else better, because that should be net of the land, right? Okay, so here is our dreaded QBI. Now, I can't spend a lot of time on QBI, but if you're not on board with QBI for regular rental property, see Ryan. No, I'm kidding. Ryan and I and Tom Grzinski and many other speakers are all in the regular rentals get QBI. So if you're not in that camp, feel free to talk to me at the break and I'll give you the Jane point of view why regular rentals get QBI. But in any event, so in our trust tax return, we have checked the little box saying this rental activity is eligible for QBI. And so then our software, thank heavens, is calculating this math for us. Because what it's going to come down to, you'll see in the example, is because we're having some income trapped at the trust level, part of that income trapped at the trust level is going to be part of the rental income. And so we're going to get a little QBI for the trust because the trust end up having to pay some tax on the rental income. So here we go. This is our little worksheet that was prepared by the software that's showing of the tentative Schedule E profit, under total, it's pushing 7293 is going to be taxable at the trust level based on how we calculated our financial accounting income and our distributable net income. So then look what it's doing. It's then giving a little bit of the benefit of the depreciation to the trust and estate there on the second line. And it's coming up with what it is deemed to be the trust or estate taxable rental income. And then I have a little narrative down here. I don't know how much time I could spend on this, but basically what I do have is a little analysis for you here of the profit on the Schedule E is the 8945 after subtracting depreciation, and 2674 of that is allocated to the trust because the trust must pay tax on that portion of the rental income because of our reduced income distribution deduction, okay? So that's why the trust gets a little bit of a benefit of the depreciation, even though it doesn't appear on the Schedule E. And 100% of that depreciation will still flow out on the K1. And by the way, that depreciation has the effect of reducing the QBI deduction for the estate. Okay, so here's our K1 for the simple trust. And so this we're going to see is going to be, we're going to show and by the way, with our simple trust, we just have one beneficiary. So this is the amount of taxable income, taxable dividends, and then the allocated portion of qualified dividends. And so here is our interest and our dividends. Here's our rental income. Remember, part of it had to get taxed by the trust, and then we got all of the depreciation allocated to the beneficiary. And so this is our simple trust, and so they're entitled to that income. And remember, with a simple trust, they may not even have received this income during 24, but this is the K1 that the beneficiary is going to pay tax on. And remember, the beneficiary may have gotten a substantial amount of income. Perhaps there's only one beneficiary. They might have closed the whole thing this year, right? He may have gotten his $500,000 of cash from mom, and perhaps they haven't sold the rental property yet, or he's going to keep the rental property for his own personal investment property. But these are the amounts. So what I'm trying to say is the amounts taxable in this K1 is not necessarily all the cash they got. But this is the taxable income of the trust that we are permitted to have taxed at the beneficiary. And the purpose of that mainly is to try to avoid the trust rates. Now, we've got some other worksheets in your handout here that shows in all these columns, the interest, the non-qualified dividends, the qualified dividends, capital gains won't be here because they're at the trust level, and the passive income, which is, of course, our rental income, right? And then how all these things are handled and land on the 1041 if you want to try to trace how some of the numbers are landing on the 1041 after our presentation today, if you need to go back and try to reconstruct how some of those items were reported. Here's our QBI statement that accompanies the K1. And so this is the portion of the QBI that for which the beneficiary can take a QBI deduction. So they're going to get the 20% of that, assuming they don't have other losses or other issues. Oh, by the way, here we go. Okay, so see, it looks like I sent Emily a screenshot a little too soon, because look here. I'm saying I've got the $600,000 property. $600,000. Oh, Bill, excuse me. Okay, here we go. I want to make sure I don't confuse anyone. Remember a little bit, we were looking at the 4562, and I was concerned that I had the value of the entire property. It wasn't. That was building only, thank heavens. So if we look here at the bottom sentence, I only have the UBIA for the beneficiary of the 420,670 because the original basis of the inherited home building only is 600,000, but we allocated part of that to the UBIA for the trust because the trust got part of the QBI deduction. So that's, I know this gets complicated, but that's why I wanted to lay everything out in little worksheets for you. So you can kind of walk it back and make sure you understand how it all landed. Now, this is our practice exercise for our complex trust. We haven't heard from the servers, so I can go ahead and get started on this. Yeah, we'll see what Emily finds out. So, sorry, go ahead.
This was a 1041 estate return. Is appreciation rules the same?
Ooh, that's a very good question. I don't see why they wouldn't be. Do you think there would be a reason? So the question is, I believe. Yeah. So the question was, if this were an estate return, in other words, someone passed away. In other words, let's say there wasn't like a B trust, or someone passed away without a living trust. So if this were just a 1041 for an estate and not actually a trust return, would we treat the depreciation the exact same way? I don't see why we wouldn't. Because again, even if you say, would the depreciation be an expense of the estate? Like the estate that, whoever's managing the estate, if there's no trust, would be potentially paying fiduciary fees and paying other bills, and no one's paying depreciation. So I don't have any reason to think it wouldn't be treated exactly the same. Yeah, was there a question? Oh, go ahead.
What if the income from the rental does not go to the beneficiary?
Oh, so the question is, what if the rental income does not go to the beneficiary? So it might not. I beg your pardon? Yeah, so that's two questions, and I'll get your question in just a minute. So the question was, what if the rental income, the trust doesn't say pay the rental income to the beneficiary, okay? It might not. Let's say someone passes away and they've got a brokerage account that's earning a lot of interest and dividends, and they've got this rental property. And let's say it's their intention that rental property be saved for one of the remainder beneficiaries, and they want to just leave that rental income as growing in the trust, okay? So what would happen is that if the trust doesn't say pay out the rental income, okay, for one thing, it'd be a complex trust. And the reason it'd be a complex trust, not a simple trust, is because in this example, there's interest and dividends and there's rental income. So since the trust isn't saying pay out all income for the year, so we already know then it would be a complex trust. And then that rental income, the depreciation would then be all allocated to the trust because the trust is being taxed on all of the rental income. And then it would have a high tax consequence of that. But there are people that do that. I mean, I have clients, every years I'll have somebody say, I don't care what the tax is, I don't want anything to pass out. And, okay, I mean, that's their choice, right? You try to explain to them what they're kind of, costing the family. But that could absolutely happen, that somebody would make that. And what if it's even something goofy like, what if the long-term tenant is, let's say, a family friend of the deceased? And the family friend, and let's say the deceased thinks her son might be mean to the tenant. Let's say, my son might try to kick her out. My son might try to raise her rent. Forget it. I want my close friend Jane to be my fiduciary and manage that rental property as long as my friend lives there, and I don't want my son to be able to touch it. So there are reasons people make those choices, believe it or not. Yes. Did you have a question? Okay, in the year of what? Okay, in the year someone passes away?
Yes. Is it still subject to the grantor type rules up until they pass away?
Yes. If the assets are held in their name and their social security number, even if they have a trust, a living trust, right? So everything would be reported in their social security number up to the date of death. It's just depending on how material the dollar amounts are. You might just say, fourth of the year, 3/4 of the year. As the numbers get bigger, you might really get down to 17 days in March or something. But generally, it's not that big of a it's not that critical where you do that cutoff. And then a lot of our clients are going to have a living trust. They're going to have their survivor's trust. And then the other trust where they've received income up to the date of their death may be from the B trust, the marital trust, right? And so that's why I had mentioned before, we might be getting a K1 from the B trust into our now irrevocable survivor's trust, which is now the surviving spouse's trust, which is now irrevocable since the second spouse died. So all those events could occur. Do you want me to go ahead and press on with complex?
No, she said lunch is ready.
Oh, good. Okay, great.
Take any final before we leave?
Yeah, are there any more questions before we break for, here we have a question back here. And just a minute. The net effect on the corpus? So anything that's spent is just coming out of the corpus, right? So for example, you may have, let's say you've got, interest and dividends this year. Let's ignore capital gains for a minute. You've got interest and dividends this year of $10,000, and they've got $15,000 of property tax on mom's house. So they, in theory, could pay out, whatever they earned in income, paid part of that property tax. The rest of the property taxes, fiduciary fees, legal fees, whatever, they're just coming out of the assets of the trust. They're coming out of corpus. But whether or not they're tax deductible is determined based on whether they're deductible for code section purposes, not whether or not they're paid from income or not. You understand? Yeah, there you go. Was there a question here? Yeah.
I just have a question on an estate beginning date. We just had a child of a deceased come in 5 years after death, find out there was a brokerage account, and they're now just getting income. Would that date be the day that they got the knowledge of the?
Well, so in theory, if nobody went and got an EIN 5 years ago, again, I would worry about materiality. And has anybody been reporting on that at all?
Actually, it came from the New York unclaimed funds.
Oh, okay. So that was just sitting somewhere, and whatever was earned on it probably was earned in that I'm going to say trust account, but it was earned where it was held by the state and then probably ultimately paid out, right? So it'd be interesting to see if they got a 1099 int that year, that like the fund said, here's your 30 grand you inherited 5 years ago, and here's your $1,500 of interest that's accumulated. So you may not really have a requirement until then, right? And it may have also passed right to them, the beneficiaries, and you may not have to file a trust at all if nobody got an EIN or anything. Yeah, so sometimes, a classic example for trust would be mom dies, let's say she's living on her Social Security, and she's living on a little bitty pension. And then she's got, maybe a tiny savings account and a checking account and her house. If somebody moves into that house for 10 years, you may have a trust, you may have an EIN, but if she's not getting interest income on a savings account, you may not file for that trust till the house sells 10 years later. So it's not uncommon to have a trust that you literally don't file for years and years. And then you file when the house sells. Because that 1099-S from the sale of that real estate is going to be in the EIN of that trust, and the IRS is going to be looking for a trust tax return in the year of that sale. But that's not uncommon to have skip years.
So